I don't win money and I don't lose money. I spend money and I make money. So if I lose money, I have to go find it. If I lose money, I'm a loser. Not me. I spend money. And when I spend money, it's in the past. It's history. It's lost. It's gone.
One of my favorite traders, Pax. How are you?
Good, Jim. How are you?
Pretty good, man. You're looking good today.
I just saw my stuff on the screen and I thought, well, all right, it's paying off. I'm tan. Where's Anthony? I want to show him how tan I am.
I'm in last place, but I'm going to catch up on the suntan, but the hair I can't do anything about. Last thing I do before I go to bed, I log in and check things out. The first thing I do when I roll out of bed at 5:30, I log in and check things out. In the last 3 days, it seems like we're almost back to normal in that overnight behavior. And when I say normal, I mean we're going back a few months, right? But from a volume point of view, we have the S&P's, overnight range now is like 65 instead of 165, that kind of thing. What do you think's happening there?
Well, I think a few things. It seems like we found a tradable bottom. I'm not going to be confident enough to say it's the bottom, but certainly a tradable bottom. And rates have kind of come down a bit. 10-year and 30 years come down a bit. Gold has found, a more realistic price, around this 33 area. So I think stability has come back into the markets a bit. So the jumpiness, the queasiness, the nervousness of traders or, of PMs and others that are going to be more inclined to control the overnight price action, I think is dissipating and it's becoming a little bit more of a normalized sort of a trade, if that makes any sense. I always put things in my own words so I can understand.
Yeah, no, we totally get it. I totally understand what you're saying. And I kind of agree with that. But, on any given moment, right, there could be catastrophic news hitting the tape to freak everything out. We're not through that 90-day period yet. We have more tariffs coming May 3rd, I think. So you got to be on your toes, right?
Oh, sure. Wednesday, I think it was Wednesday. Kind of strolled in a little bit late. And the only reason I did is because I was getting texts from traders in my group that we just rallied, I think like 40 points. The S&P rallied 40 handles off the low of the opening range, 53.43 up to like 54 even or something. And it was that huge gap. It was a 70-point gap where that market just ran. And then that inspired my tweets about making sure your stops are set to if you got Ninja, to make sure your stops are set at market. You want to make sure that your stops are market if touched, MIT orders or just market orders, stop markets and not stop limits, all about capital preservation. So I just wanted everyone to kind of keep that in mind because we can rip 50 points with nothing going on, or we can get destroyed 50 points with nothing going on and with very little volume in a low liquidity environment based off of a tweet. So you have to make sure you've got your stops in. If you're short, pay for your trade, or long, pay for your trade, remove your risk. The way that I do it is I remove my risk and I put my stops in for scratches so I can't lose any money. And if there's stop market orders, my stop might get run a little bit, but I'm more assured of getting a fill than if I'm on a stop limit, which is an important point. Anyway, I don't want to go off on that too much.
No. I was reading that. That's really good advice. There's a couple different types of stops, right? There's a stop that's a market order. There's a market if touch stop. And then there's that stop limit order. That MIT one, then boom, that's a true market order. The regular stops, I think, behave kind of like market orders. Technically, there's bands behind them, but we're getting in the weeds there. But so your MIT was great advice as we think about capital preservation. And capital preservation is more to you than just that, right?
Oh, yeah, especially on Capital Preservation Friday. I've ruined way too many weekends by being overly aggressive on Fridays and what I care to remember. If I'm up some money, well, I'm going to double it. I'm going to triple it and wind up giving it back. If I've had a really good week, Anthony the other day tweeted about after a big day or after a big run, always giving that or a large portion of it back. So you're not thinking about capital preservation necessarily. You're thinking about, hey, listen, I'm up $5,000. I'm going to turn it into 15, and you wind up giving it back. So that's part of it. You've got to think that, listen, I have made $5,000. I'm going to spend, this has got to be part of your plan. I'm willing to spend 500 of that to make another 1,000, but that's it. I've got to preserve that capital. So my plan is I'm going to put 5 or 8, whatever, 800 up as risk capital, and that's it. I'm going to leave with 4,200. Now, on the other hand, If you struggled this week, you're down money, you're coming into a Friday, without much data, we've got numbers and stuff, but without much reason to move. The trade seems to be more about the bonds like we were talking about earlier, the notes, or don't chase that money. I don't win money and I don't lose money. I spend money and I make money. So if I lose money, I have to go find it. If I lose money, I'm a loser, not me. I spend money. And when I spend money, it's in the past. It's history. It's lost. It's gone. I
Yeah.
cannot make it back. If I try to make it back, I ruin weekends by being overly aggressive. I got to get my money back. I got to get my money back. That's a terrible way of thinking of it. If you're down money for the week, you're going to give yourself the same amount of money every day that you would spend in the market to try to make more. Preserve your capital.
Let's shoot over to that E-mini S&P. I just have a daily chart, and then we're going to go to another chart with year levels on them right now. But I did want to just pull up, because we were talking about a tradable bottom here. And this is a daily candle. We have this bottom, and I go by the bodies of the candle. Wicks are wicks, but this starts on the 7th of April, 7th, 8th, and 9th. We had a little bit of a bottom. And then we have another little bit of a bottom here on the 21st and 22nd. So when we talk about tradable bottoms, how do we think about that?
Well, it's not going to adjust my trading at all. I'm not going to favor one side or the other. If we put in a tradable bottom, I'm not going to favor, the long side. I'm much more of a short side trader anyway, but it just gives me an idea as to what everybody else is looking at. Everybody else is looking still to buy dips and to sell rips, pick tops and pick bottoms. And, we talk in here every Friday since we started to not be a bottom picker and not be a top picker. Let the market find a low and start to rally and then buy them on the way up. Don't sit there in front of a running freight train and say, that's it. This is the low. This is a business. I don't want to die on a hill. I want to be like Sophocles, I think, when you're pushing up that rock up the mountain, up the mountain. The rock's a little heavy, let it come down. I don't want that rock to crush me. So the point is that you let the market find what looks to be a bottom, everybody else is picking it, and then you just trade your process. Just trade your methodology, not stand in front of it. You're better off buying them on the way back up than standing in front of it and letting that rock roll over you.
Yeah.
So, that's the way I'm looking at it. And we had extended hours made a great low at 48.32. I tweeted about that. I even showed the math on how I came up with that number, 48.34 for me. And RTH had a really good low, 48.67. But more importantly, that 49.49 level that we rallied from, I can't remember what it was the opening range that we rallied from, and we held that level. So above that, then it becomes the same levels that we talked about for the last 4 weeks. It's 49.49. Okay, where are we going now? 50.50, 51.01, and then above that to 51.70, above that to 52.82, to 53.95. We did this week, 51.90 to 52.82 to 53.95, 54.71 to where we are now. That 5509 level that we have talked about since a month before we started this, when me, Anthony, and Shy Girl did that Twitter Spaces.
Yeah, so right now, though, we're having trouble overcoming that 5509 level. I'm just going to draw my rectangle across here. I'll just park it right there. We're having trouble with candles closing above that 5509. In my mind, that's a really sticky level right now. It's an options level. There's all sorts of stuff. It's a psychological level as well. But, we do have a 1, 2, 3, 4 day kind of rally as well. The other thing that we have at that pretty close to that 5,500 level is that 50% outside fib retracement. So there's a lot of areas of interest right there. Going into Capital Preservation Friday, do we think we're going to kind of maybe hang out there today?
Yes. Yeah. This is definitely a trade I am not willing to spend any money in. I'm leaving to go to Champaign, Illinois for a college visit with my daughter as soon as the show's over. So I'm not trading. But if I were trading, I would give myself maybe 2, 3, 4 easy attempts, meaning if I buy 98 halves, it's got to go 99 bid for me to keep it. I'm not waiting for it to go 96 offer. Easy. Right or right out. That's it. I am not willing to spend any money in a market that is going to churn a market goal. The way that I think about things is that the markets have goals that they work towards. And once they achieve that goal, then it's like a magnet. Then the power of that magnet releases. So 5509 has been that market goal ever since we started to come down underneath 59.49, the yearly open. We said this on that Twitter Spaces and then also in the very first shows that we did here. Underneath 59.49, the market goal was 5509. Okay, when we held that level, 625 points up, 625 points down. When we held that level, that took us at 5509 minus 650. I think it takes us to 6860, which is the low regular trading hours. It's not rocket science. How we execute it, well, that becomes a little bit more important. But now we've achieved that goal and we're not doing anything in regards to it. And I'm not willing to spend any money to say we're going to extend higher to 5617 or we're going to come down and we're going to fail here and this is going to be the top. I'm going to let the market tell us, and I'm going to let the market tell me, and I'm not willing to spend any money in this market while it tries to figure out what direction it's going to go in.
Yeah, that makes sense. That makes sense to me. You know, the lines that we put up here, a lot of these lines have been around here for a while. These areas of interest, these targets or the magnets that you refer to, and they haven't changed that much. We talked about this earlier this morning, me and you, about this news-driven cycle, right? How crazy this news-driven cycle is. And we were just kind of like, what happens if this market kind of takes off to the upside? Then does that give more impetus to the new administration to ratchet up tariffs and other things like that, which then could bring us right back down?
Yeah, easy. The thought that I had when we were just kind of talking was now the bonds have found a low. The 30-year bond had a low of 112.23. Okay, so we opened at 114, we broke to 112, we're at 115.20. So that is a big rally in the 30-year bond. The 10-year note has had a big rally too. So rates are coming down. If rates are coming down, is that going to because from what I've read and everyone I've talked to, said that President Trump is more focused on interest rates coming down and on the dollar weakening. Okay, well, he got that. The bonds are finding a bottom, so rates are coming off. Is he going to become a little bit more hawkish when it comes to tariffs next week? I don't know, and I'm not going to try to predict it either. It's not my bailiwick. I'm going to continue to simplify my trading, preserve my capital, and trade this level to level to level. And when there isn't a level to trade, I'm going to save my dough.
Yeah, I hear you. Now, the yield curve is starting to steepen a little bit from the mid to the upper duration instruments. So right now, I think between the 10 and the 2, we're up to like 48. Let me do the math exactly here. We're up to 48 basis point separation where we were 33 a few days ago.
Yeah.
So that's starting to steepen, which is good. The lower end of the curve is just kind of lackadaisical. It's not reacting as much, and it usually doesn't, right? It usually doesn't. That's going to be more of what's the Fed going to do, a litmus test for that lower duration. But the bonds here, I love your comment about this big rally. I mean, we have that stochastic crossing up yesterday. That's a pretty bullish sign right there if it continues today. We have continuation buying today. All of my moving averages are about to get breached. That 80 EMA is shooting straight up. The 21 we just kind of traded through, and the next stop up is 50. So yeah, this does look a little bit encouraging if you're bullish bonds. Now let's go to the 10-year though. The 10-year is right in this long-term consolidation range. I mean, this thing started back February 22nd. Yeah, we had some price dislocation up and some price dislocation down. That was crazy news.
Yes, great point. That's a great point. I know the 10-year is more important, and I know that everybody's focusing on it, but I don't focus on it. The 10-year is coming into a bunch of 1, 2, 3, like a triple top here. If it takes out 111.19-ish, just a couple of ticks above. If it takes out 111.19, then it's got some room to run.
Yeah, it's funny you mentioned that level. I call these things target wicks. I love looking at these kind of dangling wicks that are big, but they kind of tried to poke through. They tried to do it. It was an exploratory scenario. And so, I'll put that ellipse around there. I'm like, all right, a close above here, which is the exact number, I half a tick off, big deal, 18.5. But a close above would be 19, right? That is going to be bullish. And then the next test is that rectangle up at top.
Right.
We break through there. Maybe this market's thinking, all right, we're going to get a regular FOMC phenomenon going on here. Folks are buying the 10-year again, and then maybe even mortgage rates start going down. Who knows? The U.S. dollar is another thing, right? So just kind of looking at the currency futures here, a lot of red on the board. And in futures trading, the U.S. dollar is in the denominator in the bottom. So when this is red, that means the U.S. dollar is green, right? It's stronger. Other than this, they're relatively subtle numbers today, so there's nothing that sets my hair on fire. But that's part of that relationship with all the commodities, because these are commodities priced in U.S. dollars.
Right.
Wheat,
Yeah.
gold, silver, whatever you're trading.
Yes, that's going to be an interesting leg too in the dollar and how that's going to affect equities. But I really think that his focus is going to be on the interest rates and what they're going to do in the 10-year, 30-year. And that's going to then drive the next leg in asset prices. If the S&P can clear this like 5509, 5506 to 16 area, then the S&P will trade up to, during the trading day, it's already traded up to 5553. Oh, look, something happened. Low liquidity event, bonds are open, and all of a sudden we're bouncing all over the place again. So bonds are rallying actually. 55.55 on the upside and then 55.89. But the ultimate goal in here is going to be the quarterly pivot at 56.17. If we get above 56.17, then we attack that Liberation Day high of 57.70, along with, I think the 200-day moving average is up there now too, 57.79. And then back up to the high that we failed from at 58.37.5. All levels that we have talked about in previous episodes, all levels that we have outlined and drawn and will continue to trade. They don't change and they don't adjust.
Yeah, so let's kind of tie together the bonds and the E-mini S&P. I did a correlation chart a couple days ago. I just threw this up really quickly. It's easy to do with the NinjaTrader desktop charting package here. The blue line is the E-mini S&P, and I have the axis on the right for that. And then the green line is the 30-year Treasury bonds, and I have the axis on the left for that. The bottom here is just an 8-period correlation, just a simple correlation, 8-period. I use 8 because it's a reasonable time frame and it's a fib number. And these things are positively correlated, right? And this has been a trend for a month now. We went from a negative correlation state, which is a normal textbook idea, right? Bonds go up, equities go down, and vice versa. And now we're at a positive correlation state where these things are going the same way at the same time. So when I see that, it's like, all right, this could be a risk-off event. Also, we're not out of the woods yet, I think is what I want to say.
No, I 100% agree with you. That all changed, I think, in like 2018. We get bonds and equities would trade it in inverse. And then when the Fed tried to end QE and start to unwind things, then all of a sudden they started to move in unison. Bonds would rally, equities would rally, bonds break, equities break. Now it's confusing. Do we have a flight to safety, flight to quality, or is it just trading on its own merits, or are they following one another? So if you're a capital flow trader or a macro trader, it's a little bit more difficult to be able to focus on the relationship between the bonds and the equities. I think, at least for me, it is. This volatility isn't over. Regardless of whether the president wants to price this stuff lower, whether they want that or not, whatever the macro situation is, I don't think that we've seen a bottom. I think we're still overly inflated. I think we still have a lot of room to go on the downside before we find any sort of capitulation. But Anthony and I were talking about it the other day. These tweets and these big vicious moves, it's not good for anybody. It makes PMs a little bit more reticent to invest, to put some money into the market. It makes institutional investors and traders a little bit more reticent to trade, and it keeps the margins for us, for independent. I don't like the word retail. I like to use the word independent traders, although I know that we're the same now. But for independent traders, people that are trading no money or trading for these funding companies, we just trade it from level to level. I'm not an analyst. I'm not paid to think. I'm a trader. I'm paid to react. And that's something that all of us need to realize. I'm not trading my opinion. I'm not trading my guesses. Trading the market from level to level, I'm going to keep my opinions out of it.
The independent trader, by the way, I'm tired of hearing folks say, well, the independent trader, the retail trader is at a disadvantage. I'm tired of hearing that. You have access to the best data stream, the best news streams, the best software, and you can make decisions based on how you are, right? You don't have to report ROI to an investor group later on. You don't have to follow certain rules that you said you were going to follow when you're trading funds or you're trading something else. I mean, this is a golden age for the independent trader. I mean, you can go long, you can go short, you could do whatever, you could change your time frames up whenever you want. You're accountable to only yourself.
That is, at the same time, one of the greatest things about this job and one of the worst things about this job, because it makes you accountable to you. And that requires radical responsibility, to be able to take radical responsibility for our lives. If I can't take radical responsibility for myself, for my thoughts, for my actions, for my words, for my deeds, from the way that I move, breathe, and have my being, if I cannot take radical responsibility for that, I am not going to be a long-term profitable independent trader. I'm going to give into my appetites. I'm going to give into my thinking. I'm going to give into my ego. And when that happens, nothing good happens. Not for trading. This is the greatest business in the world because I don't have to worry about impressing anybody. I've been a BSD. I don't need to swing it around anymore with anybody. I've swung it around with the biggest and the best in the business, and I don't do that anymore. I refuse, because what happens is my ego gets involved. And then when my ego gets involved, I start chasing money. If I start chasing money, then all kinds of mayhem is going to occur.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.